Hello and welcome everyone to today's presentation for the Transform Finance Investor Network. My name is Andrea Armeni and I am the Executive Director at Transform Finance and the convener of the Investor Network. Today's presentation will look at aligning incentives and managing impact in the case of smallholder farmer financing, and we'll be presenting the work of GAWA Capital's Huruma Fund. I am delighted to be joined today by Luca Torre from GAWA. Many of you might remember Luca from a prior presentation a while back where he very kindly shared with us the work that they had done on prior funds, with a particular emphasis on this issue of tying fund manager compensation to the achievement of the impact objectives of a certain fund. So with the topic, we'll actually cover a couple of things that are precursors to the issue of aligning incentives, as well as a derivation of it. More generally, looking into blended finance structures, but also on the next slide, we will be thinking about some of the core elements that went into the type of design that our friends at GAWA Capital did, and how we see that as interplaying with some of the considerations that we have been exploring. I would be remiss if I didn't spend just a quick second to thank you all in particular for joining us today when so much else is going on wherever you are in the world between the pandemic. Luca is joining us from Madrid, which was deeply affected by COVID. And for those that are here in the United States, with the current movement towards racial equity and racial justice and against police brutality, we think that all of this work, however removed it might seem, actually fits within a broader vision of a more just and equitable society. We take the specific angle of finance to it. And as you will know, if you've joined us in the past, we featured the Movement for Black Lives Economic Justice platform a while back, as well as a couple of sessions with activists that is looking explicitly at the connection between municipal finance, municipal sources of revenue, and racial equity outcomes, all the way from what happened in Ferguson to what happened in Baltimore. So we are not disconnected from what's happening at the current moment. This is our way, hopefully, of contributing to the amazing work that is happening under the leadership of Black communities in the United States. So as we think about today's topic and this longer-term view of how we can structure financial tools and capital pools in order to achieve more just results, we're thinking about the blended finance piece, of course, how you can stack different types of capital to achieve certain goals. But one thing that I think Luca will cover is this notion, which has been very important from our Transform Finance perspective, around capital just being a tool that is part of the solution that you're getting at. But first, you need to understand deeply what kind of problem you are solving through a particular structure. So not starting with the idea, as we have often seen, oh, we want a venture capital fund or a private equity fund to do something, but say, no, we want to do something, and the way to get there will be through a particular investment structure. Tying this also back to some of the other technical webinars that we've had on guarantees and other forms of blended finance, we want to touch, I want you to consider as we move on to the discussion part, the piece around downside protection and return enhancement. When are they warranted? How do we properly allocate it? Many of you, of course, have seen the IFCs and other pronouncements on best practices for blending capital. We also want to question one thing that has that's come up in some of our recent research, that oftentimes when there is a need for downside protection, the closed-end fund, the limited life private equity style fund, might not be the right fit. There are circumstances where a more permanent capital vehicle might work better, or where guarantees are assigned to a specific deal, not as an overlay on the fund. And I must say, without jumping into the topic too much, that what GAWA has created with the Huruma Fund seems to work actually very well with a closed-end fund in this circumstance, but we want to see how it could be replicated or how it could be adjusted in future circumstances. And the last piece that I want us to keep an eye on is the difference between where you have blended capital with downside protection or with return enhancement as a way of proving a market at the beginning, and meaning that over time there will be a lesser need for that type of subsidy to be provided. And other cases where simply there are very worthwhile investments that will just not happen unless there is a continued type of enhancement, whether on the downside or on the upside. And Luca will take us through that. Luca, if you don't mind resharing the presentation, then I will turn it over to you. Welcome, and thank you for making the time to join us today, and congratulations for all the great work that you and your team have done. So over to you.
Andrea, thank you very much, and also thank you very much for the opportunity of sharing a few thoughts today. And I would like to join you as well in thanking all the participants today. I really hope this will be more than a presentation; it will also be a discussion. I'm really excited about this webinar. Today, I would like to share a few thoughts about a fund that we have recently launched, and I'll give you a brief overview now, and then I will provide you with more details throughout the presentation. The fund is called Huruma Fund, and the objective of Huruma Fund is really to support smallholder farmers in developing countries in accessing ban consists on investing in financial service providers that are either already involved in agricultural finance or that would like to get further involved in agricultural finance, for example, by launching a specific business unit. It is a blended finance structure, and I think it is a pretty interesting structure because on one side, it has a first loss tranche, as you will see. It also has a subsidized debt tranche, and also has technical assistance to support this transformation of financial service providers in becoming agricultural ready. So the presentation today will develop in 5 main sections. First of all, I would like to give you some background about Huruma, about GAWA Capital, and also about Huruma. I would like to not only tell you about the fund, but a little bit about the process, the thought process, and also the actual process that took us to get to Huruma. And then that will be followed by a more detailed description of the fund itself, including a bit of a technical description on how the blended finance structure works, followed by another section where I would like to share a bit, my perspective on blended finance and some lessons learned. And then focusing on a key tool that has been essential, I think, to pull off this project, which is a social performance management platform that we have developed to really be able to blend in all the different actors a blended finance project, different actors that clearly have different objectives. And then I'll conclude with lessons learned. So let's dive in. GAWA Capital, so we are a fund management company. We started in 2009. We're currently managing a little bit less than 160 million euros. We've made 13 impact investments so far in 15 countries. We exited 15 of them, and we helped a bit more than 200,000 families. Most of them were female, and most of them were living in rural areas. The first fund that we launched in 2010 already was fully liquidated, and we provided investors with an interesting return of 6.3%. I will tell you more in a moment.
We have a team that has a lot of experience, both on the financial side. So all of us more or less have experience in traditional financial institutions as well as in development. The company was co-founded by Agustin Vitorica and by myself. And a big lesson learned on this is that the best thing you can really have is a great partner, which has really been fantastic since we started in 2009. And over these years, we have developed a pretty unique, what I think is pretty unique philosophy. We always try to start from the problem, and then from the problem, understanding it, building a theory of change around it, building an investment strategy, and then identifying the capital able to basically participate to that investment strategy. We also have been always trying to maximize social impact by actively managing it. We've been trying as much as possible to aligning social impact with financial incentives. We'll talk about this throughout the presentation. And we also believe, to avoid any conflict of interest, that independent verification of impact, it is absolutely essential. So in 2010, we launched our first fund. It was a 20.4 million euro fund, was investing in microfinance institutions. 70% of the investments have been debt, 30% have been equity. I would say a pretty standard microfinance investment vehicle. We liquidated that fund in 2018. As I said before, we got a pretty good return. In 2014, we launched another fund. This time it was a little bit larger, 32.3 million euros, with basically the same strategy. Was just a little bit larger, also because we got some help from the Spanish government, from the Spanish corporation. And in 2018, we collaborated with a value asset manager, an asset manager here in Spain called Magallanes. So we're advising an open-ended fund, one of their open-ended fund focused as well on microfinance. So all of these three funds have been pretty much focused on on achieving the objective of universal financial inclusion. And we always operated under two basic principles. The first one was try to maximize social performance. And the second basic principle we operated is attracting private capital to the table. Both in the first and the second fund, we engaged with private banks that distributed the fund. We engaged with institutional investors. And we really try as much as possible to bring the private capital to the table. And you know, as I said, we made 30 investments in 15 countries over the past 10 years, all pretty successful, despite I don't know now with COVID, but we haven't had any investment that has gone sour, at least which hasn't lost any money. So overall, we developed, I think, a pretty good experience in different continents. And throughout these years, there were also two things that we learned and we realized. The first one is that out of all the investment we have made, out of the, I would say, hundreds and hundreds of clients, beneficiaries that we have met during the due diligence, rural clients typically are the one, they are the poorest. And you can see that also on statistics. And also we have seen that there is a huge credit gap among smallholder farmers. And part of the reason for that is that we realized during this experience, during this 30 investments we have made, that microfinance institutions are typically not equipped to serve farmers with the right set of products, with the right set of, with the right risk management system, or they don't employ the right people. Out of the 30 investments we have made, about 2/3 were rural-based microfinance institutions. And a vast majority of these microfinance institutions were just either didn't have these three components, either didn't have the products to serve farmers, didn't have the right risk management system, or they didn't have agronomists, for example, within in their loan officer base to really be able to provide a good service to farmers. On the other side, we also made few investments in microfinance institutions that did it very well. So we saw that agricultural finance can be done and can be done well with very stickiness in your client base, but you need to adapt basically you need to adapt the risk management system, products, and people to this specific segment. So 2016 came, 16, 17 more or less. We already had two funds under our belt at that point in time. We had investors that were happy, and they asked us to basically, so in 2016 we had to decide, we know both funds were closed-ended funds. So we needed to launch, as you know, with closed-ended funds, you need to continue launching new funds. So we had to decide what to do next. And the more obvious options we had was to launch a third fund based on, with a very similar structure of the other, of the other two. A closed-ended fund focusing on microfinance, having as an objective universal financial inclusion. Well, 2016-17, we realized that the objective of universal financial inclusion was already partially achieved. If you're a poor person in an emerging market, you want to access a loan, you can do it. You have access to microfinance institutions almost everywhere you are, and microfinance institutions are able to finance themselves locally, most often cheaper than if I come with money from Luxembourg to the emerging markets. So we thought it doesn't make sense from a social standpoint to go and do the same thing again, to launch another fund, despite the fact that our current investors, the private bank especially, they said that's what you should do. Our clients love your product. We say, no, that's not really the right thing to do. But we learned those two things that I just mentioned before. We realized that there was a segment which was not very well attended, which was the farmers. And so we decided to basically start focusing on this specific issue. How can we build an investment strategy that can solve the specific issues, helping smallholder farmers accessing financial services? What happened over these years? This is a metaphor I typically use, which I think is pretty powerful. I think the development community over the past 20 years has built motorways to achieve financial inclusion. Now what we need to do is building the smaller provincial road, then go and solve people's problem. Farmers, for example. In the other, in another interesting areas we're looking at is, SMEs, which are also still quite unattended. Green lending at a very granular level. Water. There are lots of problems that can be solved by using all the financial infrastructure for the poor that we have built over the past over the past 20 years. So we went back to the drawing boards and we said, okay, if this is the problem we want to solve, we want to help smallholder farmer, what is the theory of, so and what we did, we became as a team obsessed with agriculture. So we just started studying, we started traveling a lot, we started meeting a lot of farmers, a lot of clients, we started talking with a lot of microfinance institutions to understand in details what the issue was. And we built a theory of change, which is pretty straightforward, but I think it's important to mention, which is if a farmer is able to get access to financial services, he will be able to buy better inputs, fertilizers, seeds, irrigation systems, etc. They will improve their yields, they will improve their income, and as a result, they will be better off, and we will have the outcome and the impact that we have been looking for. So key was how can we provide farmers with access to financial services? And here there was there are two channels that we identified. One is let's try to get financial service providers to really start working for farmers, which at the moment they were not doing it. And then let's also use value chains. Value chains can be a very powerful channel also to vehicle credit, especially credit, but also extension services really to farmers. So this is basically the idea and the investment strategy that we built to solve this very specific issue. Well, we went back to our investors, and I'm talking again about private banks, family offices, etc. We told them about this idea, and first of all they asked us, but why we told you that we like the other fund? Why are you doing something different? And we explained to them that what we wanted to do was really to solve this specific market failure and this specific issue. And so, you know, they clearly had the perception that this fund, this project was riskier than what we have done before. So what happened is that we went to, and we understood that, you know, that really was a fair feedback. So what we did, we went to COFIDES, to the Spanish, and to AEFID, to the Spanish Development Agency. We presented the project. They really liked the project. And they said, you know, they said it could help us. You know, they could help us because the project was interesting, and they could help us finding ways to de-risk the perception. Because at the end of the day, I believe it's a perception of risk. It's not a real risk. They could help us de-risking the project in the eyes of the private investors, and possibly also increasing the return to make it a little bit more interesting from the private investors. Remember what I mentioned before, for us was absolutely key to bring private investors on the table. It's what we have been working with over the past years. So on the slide is what you see the structure, the final structure of the fund. You can see it on the right-hand side. The European Commission provided us with 10 million euros of first loss tranche, and I will go in details for those of you who are interested in how that works in a following slide. Then we have 90 million euros of private investors. The fund is basically oversubscribed. We have one large institutional investors that we will hear from, hopefully positively, in the next 10 days. If they confirm, as they and we hope, we will be oversubscribed. So this is the risk in work. And then we also had 20 million euros of subsidized debt pari passu with the private investors. And I'll walk you through the structure in greater details in a moment. So this is to finance which kind of investment strategy? I mentioned it earlier, but just let me go through in a bit more details. This 120 million euro fund is planning to invest at least 70% in rural focused microfinance institution, maximum 30% in rural small and medium enterprise, which is an area that, I have to be honest, we haven't made any investments yet. So this is an area that we need to learn more from. And 70% will be debt, 30% will be equity, the investments we'll be making. And the geography is 70% will be Latin America and Sub-Saharan Africa, and the remaining 30% will be Asia. I stop here a moment to check if anybody has any questions and want to ask anything.
Thanks, Luca. For now, there is a question from Eric Linson on if you can provide some sense of the size of the loans to the farmers. And I encourage everyone else to put their questions either in the chat, or you'll see at the bottom of your screen a Q&A icon that you can use as well. So current question is on the size of the loans to farmers.
So what the project is about, and I think I should have mentioned it in the previous slide, really. Our objective, our investment strategy is to empower microfinance institutions and other financial service providers to provide the right financial products to farmers. And we're planning to do that not only with an investment, which I just described how the capital structure is structured, but also with technical assistance. So the technical assistance, we have 8 million euros of technical assistance from the European Commission and a vehicle through COFIDES, the Spanish development institution, to basically help the financial institution to implement all the changes that are needed to serve farmers. So I don't have the answer to this question because it really depends on the context. What we will be sure, our objective is that as much as possible, the financial institution will offer products that are tailored to the client needs. So in Latin America, this is our experience, but in Latin America, average loan size will be in the order of $1,000. In Asia, in India, it will be smaller. In Africa, might be even smaller. So it really depends on the kind of farmers that the financial institution will be attending. Typically, organized farmers will require higher amounts because typically they also have more land, and more subsistence farmers they will require lower amounts because basically they just have smaller land and they have smaller needs. Perfect. So if there are no further
there are a couple of things. Let me read them out to you, Luca, and then you can handle them in turn as or either now or later in the presentation. One from Songbai, how different the target portfolio is from MFIs that the earlier funds invested in? So how different from the prior funds? Another question from Jana Stoney on what you're charging to the MFIs for the capital. And should we start with those two, and then I can give it the other ones after, perhaps?
Perfect. So on the interest rate will basically do market rates, but we'll create the incentive. So what are we going to do a bit different than other microfinance investment vehicle? One of type of capital the microfinance institutions lack is longer term capital. So that the microfinance institution can basically finance not only working capital to farmers, but they can potentially also finance a bit of a longer term capital as well. As again, capex, irrigation systems, wells, etc., etc. So the interest rate will be commercial, with the hurdle rate, to be fully transparent, the hurdle rate we have, it's 4% in euro. Could be a little bit lower, but we don't expect to go much lower than that. But that's in euro. We always provide the financing in local currency. So to that, you need to add the cost of hedging as well, which varies a lot from country to country to country. One thing, yes, I was going to mention it afterwards, but I'm happy to pick it up here. We might be considering. So one thing we're very concerned about is impact risk. So what happens if we make an investment in a microfinance institution? We start providing technical assistance, hoping that they will get into this transformation journey to make them agricultural ready. And what about if in the middle of the journey they decide to pull out, for example? So in this case, we're considering incentives. So for example, if certain goals are met, social goals, we might reduce, we might give a rebate at the end of the life of the investment. And also we're structuring our loans in a way that can be callable. So we can give a 6-year loan, but if certain milestones, social milestones, are not met, then we might ask to be repaid a little bit earlier on. In the meantime, I forgot the first question, Andrea. Can you remind me?
Sure. So the first question was on how different the target portfolio is from MFIs, from your earlier funds.
Yeah. That's a very good question. So there will be some overlap because again we have seen a lot of microfinance institutions that we work with that do need this product. There will be some overlap, but the overlap will not be total. I would say that probably 20% of there would be probably 20% of overlap, 20-25 probably. What we're seeing, especially true in Latin America. The microfinance market is pretty mature, and I would say also in some cases pretty saturated as well. So we're seeing a lot of microfinance institutions that are interested in differentiating their offer and trying to address new market segments. And they've been trying to work on the agricultural side and trying to cover this segment, but they don't really know how to do it. So we have seen a lot of interest among microfinance institutions in working with us around this project.
Thank you. I'm going to drop in the other questions that are coming up in the Q&A in case you're not monitoring that while you're speaking. So I'm going to put them here in the chat.
I have it as well.
Okay, so if you have it, if you want to address any of those, and if you want to leave them for afterwards in your presentation, up to you. Thanks.
Yeah. We do not expect to purchase land. Absolutely not. Again, and this is also because it's something I haven't mentioned before. We don't know how to do it. I mean, our track record is about investing in financial institutions. That's what we've been doing also in our previous lives. So I think I wouldn't feel myself comfortable in purchasing land. I wouldn't know how to do it. So and it doesn't really fit in the investment strategy. How do you foresee exit occurring? 70% of the portfolio would be debt, and only 30% would be equity. So the debt is by definition self-liquidated. In the equity, equity will be either equity or mezzanine. The equity will not, and we've been very diligent on that, very disciplined with our previous fund. We typically don't make equity investments unless we have a clear idea and we see some clear options of exiting. And that goes beyond the traditional put option that you might put in a loan agreement, in a shareholder agreement. You need to think that this asset, if everything goes well, will be palatable to some other investors along the way. So for us, it is key, and this has been why we've been pretty successful in exiting investments, equity investments as well, so far. Currency risk, as I said, the debt is completely covered, and we do use MFX. You might be familiar with it. Is a US OPIC-backed FX service provider. We're working with them for a long time, and I think that's it. We're not question about if we're targeting some specific crops. We'll leave that to the financial institution. Again, they are the ones that, so it will really depend from country to country. On the SME side, also, that will depend. I think on the SME side, we will be gearing more towards export crops, because to be quite frank, it is a little bit easier to invest because there is more of a track record, but we don't have any specific crop that we're targeting. Now, you have last was a very interesting question, is whether agricultural lending is true. Agricultural lending is quite specific, and if I think that microfinance institutions should be really specialized exclusively on agriculture, there have been a lot of models coming up recently, especially tech-based, that have been really specializing only on agriculture. I think my perspective is the two models will go one with another. So both models will exist. I think we're seeing and we'll see increasingly agricultural finance specific financial service providers, but I think that microfinance institutions as well as banks, leasing company, they also have a role to play in agricultural finance. So I think that was the last question. No, there is one last. Do you invest in small farms that have not yet reached profitability? We don't. We only invest in, as I say, in financial service providers and agricultural SMEs that already have a positive track record and that already have profitability. We are not. We're not taking operational risk on the SME portfolio that we're planning to build. I think we answered most of the questions, so which were on the chat box. Then I think I can probably move forward to the next to the following slide, which I think it's just to provide you some details about how the structure works in a bit more details. So as I mentioned before, there is a first loss tranche. There are three tranches basically. There's a first loss tranche, there is an equity tranche, and there is also a 20 million euros of subsidized debt. Now the complication here, and I'm not going to go too much in details, but if you like to, I'll be happy to give you exactly how it works, even on a separate. Feel free to just reach out to me after the presentation. But basically, the first loss tranche and the equity tranche are structured in a Luxembourg SICAR. It's the traditional, I would say, private equity vehicle in Luxembourg. And the debt, the subsidized debt, is outside the fund. It's in a special purpose vehicle, in a securitization vehicle, and the reason for that is just that the Spanish Development Agency had some limitations on how on the kind of investment they could make. So they just could not invest that in the main vehicle. So we decided to structure it separately. The way it's going to work, the way it is working, it is that the fund provides a 2 million euro equity in the securitization vehicle. So the liabilities of the securitization vehicle are 2 million euros of the fund that the fund put, plus 20 million euros of subsidized debt. The portfolio, the asset side of the securitization vehicle, reflects proportionally exactly the portfolio of the assets of the fund. So every investment we'll be making will always have two different set of legal documents. One set of legal documents to document the investment from the fund, and the other set of legal documents documenting the investment of the SV. This has the advantage for the private investors that really, despite being a very subsidized debt, the interest rate it's really fairly low. Despite that, it's basically becomes pari passu with the equity investors, because really the equity underlying the debt is very small. It's only 2 million euros. How does it work, the cash waterfall of the first loss and also of the subsidized debt as well? So we make all the investment, we build the portfolio. Once we start liquidating the investments, the cash will first go to the private investors until the private investors reach a 4% return. Then after that, the cash goes to the first loss tranche until the first loss tranche reaches 4% return, and then from there on, it is pari passu throughout the life of the investment. So this is not really only a first loss; it's really a first loss plus protecting some minimum return for the private investor. The life of the fund is so it's 5 years investment period plus 5 years of divestment for a total life of the fund of 10 years. Hope this is clear. If it's not clear, please let me know. And if you have questions, feel free to put them in the chat box. Okay, let's continue. So far we have been talking about the structure of the fund, but as I said, the European Commission also provided us with 8 million euros of technical assistance to support our investees in achieving that kind of transformation. How does it work? So it works in the following way, very operationally speaking. Once we do a due diligence, we also do a pretty thorough social due diligence where we try to understand what the potential social impact is of every single investee. And we also do a agricultural readiness gap. So we're thinking about what does it take for this financial service provider to become agricultural ready. And I'll speak in greater details afterwards on how we do this. But basically, out of this social due diligence, there are two different documents, activities. One, which is the technical assistance needs document, where there will be a very detailed document that identify which are the technical assistance needs and what will be implemented, and this will go through the technical assistance committee, which is run by the donors, and I will not go too much in details in that. But also, we use that information to really prepare the legal documentation and putting social covenants in the loan agreements, putting social covenants in the shareholder agreements. So the final objective is to have a financial institutions that is better prepared to serve the agricultural clients, and we're trying to achieve this objective in two ways: through the documentation and the investment, but also through the technical assistance. Because going back to the technical assistance, once we have identified the needs and the gaps, we'll go on with the implementation, and hopefully at the end of the implementation, we'll have a financial service provider which is better prepared. But also through the investment routes as well, because these social covenants as I mentioned earlier as well, will be monitoring them along the life of the investment. So I think this is a pretty powerful concept. The second stream, the social covenant, is something that we have already been doing a lot in our previous funds, and we got quite a bit of success in getting improvements from a social standpoint implemented in the investees. Here, the key message is really there are two different ways to achieve two different levers to really achieve the final result. Any question that you might have? Feel free to unmute. No, I don't know if unmuting as well is possible, Andrea, but feel free to unmute yourself as well, if you wish.
Yeah, if you want to ask directly instead of writing it down, you can raise your hand and I can unmute you. Thank you, Luca, for offering that to the attendees.
Okay. Okay, two questions on the chat box. There are not specific countries that we will, well, this is not true. We're going to try to focus on countries that where the finance gap is the biggest one. And also, one thing we'll be trying to avoid, our experience tells us that typically investing in financial inclusion risk is really, most of the risk is really focused on regulatory risk. So we really try to avoid countries with very populist governments. But otherwise, we don't really have any specific countries we'll be focusing on. And then the other question, in the event of default, if they don't achieve, the question in the chat box, is it an event of default if they don't achieve the social metric goals? How do you put teeth into covenants? It's a very good question. So far, the social covenants we have put in the loan agreements were on a best effort basis. So we didn't put teeth to those covenants. In the case of Huruma, there will be teeth, because as I was mentioning before, I think it will be a bit too strong to ask for repayment in case a social covenant, social metric, a social covenant is broken. But we might not renew a loan, or we might not providing a rebate, a reduction in interest rate in case certain social metrics are not achieved. There is another question. I'm curious about whether social covenants also include things like food diversity for improved nutrition or enhanced agroforestry and intercropping for improved biopest control, for example. We will not get into that specific. Again, our objective, our mission is to get financial service providers agricultural ready. So the social covenant will be very much focused around that. It's about ensuring that what has been laid out at the beginning of the investment as a transformation journey will actually be fulfilled. So that, for example, that agriculture-related products are actually launched, that management systems have been implemented, et cetera, et cetera, et cetera. But we will not get into the level of details you're mentioning, Jennifer. So another question: what are some examples for a particular country of your social covenants? Let me give you an example. This is actually not a covenant that we have. This is not a covenant. We put this covenant in a previous loan agreement a few years ago. Actually, let me give you this example. This is a good example. It's a microfinance institution in Central America that they have a portfolio. We have two products in their portfolio. One product was showing interest rate on a declining balance basis, which is the right way to do it. And there was another part of the portfolio which is showing the interest rate on a flat basis, which is bad because clients don't really understand flat interest rate. Typically, flat interest rate looks lower, but it's not. So it's basically a bad practice. We decided to make the investment anyway because it was a very well-intended microfinance institutions, and they clearly had reason for that. But we said that, we put that in as a social covenant, and over the course of the investment, I think after the first or the second year, they did make the change and became more transparent with their clients. With a couple of clients, for example, that implemented environmental policies that they didn't have before. We have a client that really took an effort and did a full social certification and start developing a real social strategy, a social performance strategy in their institution. So this is the kind of change that we try to foster through those covenants, really. One last question: did you consider lending to co-ops? We could lend to co-ops, and we're planning. We might be doing that. Yes, absolutely. Especially export crops potentially. Okay, let me continue then on the next section. So, just want to share a little bit our experience in building a blended finance project. No, the issue with blended finance, we all know this well, is that you basically have different stakeholders which have different priorities and objectives. You have the catalytic capital providers that decided to give up returns or take more risk, or both, to catalyze private investors. And then you have the private investors that are primarily focused on market returns, and they want to basically have a financial return. They also are interested to social impact, that not necessarily their priority. So here I put some of real comments that we got. So, for example, on the catalytic capital providers, this is a question that comes out very often. What is the right level of support to catalyze private capital, but not offering a free lunch? How can align manager incentives with solving social problems? I mean, we have been, we as managers, as on a blended finance structure, we clearly have to serve two different stakeholders. And so our incentives so far, typically on private equity funds, have been only focusing on financial returns. How can we also have an alignment on the social return, et cetera, et cetera, et cetera. And on the other side, the private investors are more concerned about whether they're taking too much risk or if their return is adequate. So in our experience, there are three elements that are key to resolve this kind of dichotomy. One, we found it extremely helpful to spell out a clear theory of change. And around that theory of change, you can really build a dialogue with the catalytic capital providers. And then the other element, which is extremely important, is to basically, around the theory of change, build a social performance impact management system that is accountable to basically all stakeholders. And this platform, which I'm going to get into details in a moment, has to be focused on key principles like transparency, has to focus on transformation, and needs to be focused also on how can we integrate technical assistance to the project. This is the last section of my presentation, so I will talk about that in a moment. And the third element, which has also been key in pull off the blended finance, this blended finance project, it is to have social carried interest. Andrea mentioned this at the beginning, and I'll explain it in greater details. Our carried interest is tied to achieving a certain social performance. More impact, more carried interest; less impact, less carried interest. And I'll walk you through the real formula in a moment. Before moving forward, I see a question here from Sajid. How does the fund governance structure incorporate the voice of ultimate borrowers? It is a very good question, and I have to say that we thought about that, and I don't have an answer. And I think that the plan we have, but it's difficult, The plan we had was we have an advisory board, and we want to have, and we hopefully will have the voice of the borrower in the advisory board. That's an answer that we're trying to, that's an instrument that we would like to implement to really be able to hear their voices as well. I don't know if by borrowers you mean the investee, so the microfinance institutions, or the final borrower, so actually the beneficiary. The beneficiaries is a bit more complicated. It's just, we've been thinking about that, and I think the way to do it is to be on the ground and talk to them as much as possible, and being well-intended and trying to solve problems. And we'll try this advisory board as well, but we'll see. And talking about farmers, we do have in the advisory board, we do have, really important, so you meant farmers. In the advisory board, we had agronomists and people that know a lot about agricultural finance. And also we have a technical assistance director that has been working extensively with farmers and with cooperatives. So those voices are integrated in the project this way. So let me move to the final section. Let me move to the final section of the presentation. The social performance management system. Key for us has been that the social performance management system has to be integrated with the investment process. So at every stage of the investment process, there is an equivalent activity that helps maximizing the social impact. That's really what the social performance management system is a system, is a set of activities, is a process to really to optimize the social impact. So the origination, we clearly try to pick, we have a pretty extensive pipeline, we build extensive pipeline, and one of the filter is clearly social. So we try to screen as much as possible the opportunity on the social side. On the due diligence side, we typically do a very thorough social due diligence. So our investment committee always receive 2 sets of documents, which are, probably a 30, 40 pages financial due diligence, business due diligence, and then a 15, 20 pages social due diligence, and agricultural readiness due diligence. So really understanding what's the potential for transformation and social impact of this financial institution. And we typically use, so we use a mix of both existing tools. For those who are familiar with financial inclusion, we use SPI4 or Alinos. Is a tool that's been developed by the Social Performance Task Force. It's very helpful to assess how prepared a financial service provider is to deliver its social mission. Or we also have other tools that we developed internally based on IRIS and other existing infrastructure, but that we developed internally. Then we come to the documentation, and here I mentioned already in documentation, social covenants are key. I talked about this already. And then the monitoring side, which is also very important. We do monitor social performance throughout the life of the investment, and as I will tell you in a moment, we get it verified by a third party chosen by the investors at the end of the life of the investment. Now, clearly, to achieve integrate social performance management system in the investment process is essential to a very well-structured matrix system. And we organized our matrix system around the theory of change. So we have 3 sets of metrics that we monitor. And I'll go in as much details as you wish on these points. The first one that we call input, which is basically transformative metrics, which goes around our metrics that try to measure how equipped it is a financial service provider in achieve the social mission, both in terms of agricultural readiness, but also in terms of do they have a social mission are the products good products for clients, not that goes beyond the agricultural component. This is the third kind of metrics that we do measure. Then another set of metrics is what we call output metrics, which is basically how many clients we're actually able to reach. In this case, the objective of Huruma is to reach at least to 100,000 farmers that will receive financial support from the project. We measure this throughout the life of the investment. So we measure this at the beginning, and we measure this at the beginning of the life of the investment, and then throughout the life of the investment, and then at the end of the life of the investment, we send a third-party providers that measure this set of metrics and provide the project with a final portfolio rural impact score. Basically, every investment has an impact score that goes from 0 to 1, and depends on, I'll show you in a moment, and it depends on a certain set of metrics and question. At the end of the life of the investment, we send a social auditor that audit this social performance, this metric. We do this for every single investment we have made, and we make an average of all these impact scores, and so we have a portfolio rural impact scores that goes from 0 to 1. Well, this score is what affects our social carried interest. The formula specifically, it is 10% plus the portfolio rural impact scores that goes from 0 to 1, the highest, the better, the lower, the worse, times 10%. So basically, our carried interest can vary between 10 to 20%, depending on the social impact, and depending on the rural impact score. Here it is important. Then another set of metrics that we might, if we can, also measure are outcomes. Measuring improving yields for farmers and income for farmers. Unfortunately, this is more difficult because we do need the collaboration of the MFIs, and many MFIs are not equipped to measure this. We'll try as much as possible to push them to do so through surveys and changing their information management system to capture those data, but this will not be possible all the time. However, we believe that even monitoring only transformative metrics and output metrics, we kind of predict that the outcome will happen. Because when we prepared our theory of change, we looked at evidence. We looked at studies, scientific studies, academic studies that have been done that show that if a farmer is able to access good quality financial services, it will be able to basically increase their yields, increase their productivity, and as a result, be able to improve, possibly get out of poverty. Is it clear? Any questions? I guess not. Okay, good, perfect. So getting a little bit deeper on the two kind of metrics that, as I said, we measure the output metrics. We try so basically how many clients, how many farmers we will reach. We've broken the segment of smallholder farmer. We've broken the smallholder farmer segment in three different sub-segments, so to say. One is the commercial smallholder farmers in tight value chains. The other one is commercial smallholder farmers in loose value chains, and the other one is subsistence farmers or non-commercial smallholders, which this is a segmentation which was provided by a very interesting study done by Dalbert a couple of years ago. And as I said, the objective is to reach 100,000 farmers. Now, on the agricultural readiness score, and I think that now everything will become clearer on the metric side, there are three, we believe that, and I mentioned this before, there are three elements that make a financial service provider agricultural ready: having the right people, having the right products, and having the right processes. So on the people side, as I said, do people have the right? Does the MFI have the right agronomy kind of knowledge? Is the board of directors kind of trained to agricultural finance? And on the product side as well, we very much value a multi-product approach and doing a lot of, for example, customer surveys and listening to the client centricities. And on the processes side, also, you need to have a very specific risk management system tailored to agriculture. To measure that, we have a bunch of questions. You see here a few examples. Many of them are yes or no questions. Some others are questions that provide a level that goes from 0 to 100%. And depending on how the answers to these questions, the rural impact score will be higher or lower. For example, is the board of directors and management of the financial institutions trained for issues specific to the agricultural client and receiving regular reports at the board level? If the answer is yes, the rural impact score will increase. If it is no, it will decrease. Does the financial institution offer insurance products for farmers? If the answer is yes, the rural impact score will be higher. If not, it will be lower. Does the financial institution management information system generate specific reports about agriculture and livestock lending activities? Again, if the answer is yes, we'll get a higher score, and if it's no, a lower score. There are a bunch of questions like this that basically provides a picture, a photograph on how well prepared the microfinance institution is to offer products. Now, I think the beauty of the system is that our incentives as managers, given that our carried interest is tied to this, is that we want to have this rural impact score growing during the life of the investment, because our carried interest, it is calculated at the end of the life of the investment. So we could decide to invest in a company that is not great from an agricultural readiness standpoint at the beginning, and we'll have a number of them. We'll have some that will not do agricultural finance at all, but we want to be sure that at the end of the life of the investment, this score, it is as high as possible. And then, as I said, we do monitor this score during the life of the investment, and we report it to the investors with some detailed description of what happened. What you're seeing here is actually a slide from our latest investor report of our second fund, of the Global Financial Inclusion Fund, that report that provide the investors with, where you can see how the social, in this case was called portfolio social impact score, because it's not tied to agriculture, because the Global Impact Fund didn't have any agricultural focus. But you can see how this score basically moves over time. And here on the side, there are some explanations on why the score has basically moved over time. I could see some questions that I'm happy to answer. Did you cover how much third-party auditing cost, percentage of the overall cost of operating of the fund? The costs are really minimal. So the auditing costs are paid by the fund, but they're fairly small. So per investment, we're talking about in the small thousands. It's fairly small. and I have to say that every audit includes a visit of the auditor a personal visit, an on-site visit. For our second fund, which we have this system, we already done a lot of, we already selected the auditing for, well, the investors already have chosen which auditor is doing all the auditing, and in this case is Microfinance Rating. For those of you in financial inclusion might know who they are, and they already performed a number of audits already. I think the cost is fairly small because we contracted this party for the whole package, and so they were able to reduce quite a bit the overall cost. Again, the cost is not huge; it is fairly small. Okay. Any other questions you might have on this? Well, I can see here there is another question. Are you guys structuring self-liquidating equity within your portfolio? Can you mention a bit on the structure itself? So we're considering doing self-liquidating equity when investing in agricultural SME. And that can be as you know, in different forms. I think more than everybody has on this, you know, we're thinking about mezzanine structure, and what you're referring to, it is a mezzanine structure. One of the structures that we've been discussing and considering, it is, for example, participative loans, where the interest rate can increase substantially if things go very well, and decreases if the business is not basically doing well. That's some structure that we have been considering on the mezzanine side. Clearly, when you're investing in agricultural SME, a key issue is exit, and so we're very, as I said before, we're very obsessed with exits. We are not going to make an investment if we don't have some kind of idea on how to exit. And so the self-liquidating structure can be very helpful for investments where an exit is not clear, and agricultural SMEs often is the case. I don't know if you, any other questions?
I was wondering, once you're done with the rest of your presentation, if we can save a couple of minutes, Luca, to to talk about lessons learned, potential replicability, what you do differently, etc. And I think others on the line might share with me the sense that this is a really impressive setup, and also a complicated one if somebody were to restart it from scratch. So maybe you can share with us a bit on what can be adapted, etc. Thank you. Yeah. So I put here like 5 lessons learned. I think these are I think the most important part. Blended finance works very well. Fundraising so it took a long time to set up the public capital. This is important. It took time because, of course, it's public money, and it's right that it would be taking time. There is a lot of check and balances, and there is some bureaucracy. But once you have set it up, it really works well. We have been engaging one of the largest bank in Spain has decided distributing the fund to their private bank clients because of the structure. So absolutely new investors that have never invested in impact investing before, decided to come in and invest in our fund, really because of the structure, because of the confidence that they had in the first loss tranche, and also in the return enhancement. But in my view, blended finance works well if and only if you have a very specific social issue, market failure that you want to tackle. And you have a theory of change around it to tackle it. To me, this is essential. And to be honest with you, that's the definition that at GAWA Capital we give to impact investing. Any investment that doesn't try to solve a specific issue, it doesn't have a theory of change on how to resolve the issue, in our view, I might sound a bit extremist on that, but it's not really an impact investment. I'm exaggerating a little bit, but just I was trying to get my point through. And then two last points, lesson learned, is that
you can build the best blended finance structure, but a solid track record is also, for the most part, needed. Our private investors, the private capital, were confident on the fact that if something went wrong, they had some protection, but they also wanted to see that historically, not very often things went wrong, that our track record was actually very positive. And so I think track record still is very important. And finally, I think transparency and alignment of interest is absolutely key to put all the stakeholders together. I'll stop here. I'm sorry, I've been taking a long time. I hope this was clear. Happy to answer any question, and feel free to reach out to me. I'm very happy to, if I can be of any help to any people in the audience, very happy to, to engage in a separate discussion.
Thank you, Luca. While others write your questions and comments, I wanted to raise one on that lesson learned, the number one on blended finance. We often do see this attention to the downside protection, but oftentimes I think the pain point for new investors that are not familiar with the space, for new entrants, is not necessarily the downside. It could be a lack of liquidity or the limited upside. Is that something that you have also seen, or was it generally, in this case, largely the downside that was that could be played with in the blended finance piece?
I don't know. I think it depends on from investor to investor. I think, in my view, investors have been, at least that's the way we have been working with investors over the past 10 years. We really try to focus a lot on capital preservation. That's a key word for us. We might not provide you with the exciting high double-digit returns, but we're pretty confident that you will not lose money. So in that sense, I think that having the first loss piece provides even an additional confidence. I think it's really clearly you mentioned it, the barrier of and we've seen an evolution. The other barrier that we're seeing is the closed-ended fund, right? The fact that you don't have liquidity for 10 years. I have to say that personally, since we raised our first fund in 2008, 2009, investors' perception around this has changed substantially, and investors are now, in my perspective, more willing to basically take a leap of faith and marry a project for a longer term without having any liquidity. So I increasingly see it less of a constraint.
Great, thank you for addressing that, Luca. And I should have been maybe disclosed. The reason for the question has been that as we have looked at evaluating some guarantees, whether they perform well in terms of crowding in the right type of capital from investors that would have not previously invested in a specific social issue, as you put it. We saw that for some investors, the downside protection was going to move them. For a lot of them, it was the downside protection plus the liquidity plus the level of returns. And I think I appreciate your approach, and it resonates with us that at some point, for some people, it will work. For some others, if they're looking for more exciting returns, maybe there's they can look at other funds that probably are not doing the same thing. So I doubt that going back to the very first point that we made, even the best blended finance mechanism can solve all the pain points for the investors if it still wants to remain true to the needs of the ultimate beneficiaries of the investments.
Yeah. I think there are
I think we might have covered most of the questions here, and thank you to everyone for not being shy and speaking up during the presentation itself. I'm glad to see how many questions were asked, and I'm so glad that Luca was able to address many of them. I would say, Luca, if you don't mind us sharing your contact information with the participants I have asked to be in touch afterwards.
Absolutely.
Yeah.
Yeah. Here you go. So feel free to just write me. Happy to help.
Great. And similarly, feel free to reach out to us at Transform Finance if you have any thoughts on this, or if you have seen other examples that are worth lifting up. Or I will echo what some of the participants have said, that the level of thoughtfulness and the level of transparency we see here is really at the highest levels that we have seen. So thank you, Luca, for the work that you've been doing for years and for being willing to share it with us. This has been extremely informative.
No, thank you. Thanks to you all, and thank you, Andrea, for giving me the opportunity. And also, if you have any suggestions, feel free to write me as well. If you think there are things that we could do better, I'll be very happy as well to ideas, pipeline. I'm very happy to continue the discussion. Thank you very much, you all.
Great. Thank you, and thanks to all the participants that joined us today. Thank you for being so active. Thank you for being so patient with the little technical difficulties that we had at the beginning. So have a good rest of your day, and thank you again, especially to Luca. All the best to everyone. We'll adjourn the session.
Bye bye.
Bye bye.
Thank you.